Hi everyone, Tom Buck from the Calder Group, and welcome back to what is a growing and regular format now of having a look at what's happening in the markets, the impact of coronavirus and what's going on, and cutting through the noise from the media and actually looking at what you need to understand, what you need to know, and more importantly, what actions you need to take if you're still looking at planning around your investments and pensions over the long term. As normal, I'm happy to say we have one of the, as my clients put it, one of the most optimistic men in the world with me, Alex from Blackfinch. Hi, Alex.
Hi there. Hi, Tom. How are you doing?
I'm not too bad. How are you coping?
Good. Yeah, all very well, thanks. So I'm bedding into working from home life, so it's going absolutely fine, to be fair.
Oh, good. Okay. Right. Clients are enjoying what's coming out, so we're going to keep it to the same format, if that's all right, Alex. We'll go through some questions. Let's cut through the noise and let's actually see what we need to do. So, I suppose one of the first questions is, as portfolio managers, we've seen the falls in asset values across the market. We've seen portfolios fall in values by over 10%. I suppose the question is, what steps are you taking as portfolio managers, or what steps have you taken to manage the portfolios, and why are you taking them?
Yeah, exactly. So, I mean, over the past month or so, there's kind of been three areas of core focus that we've been looking at in the portfolios. Firstly, you'll be aware that there's property exposure in all of the portfolios. So that takes a wide range of underlying assets, from commercial to retail to residential to healthcare. One of our concerns is that coming out of this virus and sort of in a post-COVID-19 world, we are starting to perhaps question office space in particular. The main reason really is kind of what we're doing right now. Companies and employees' abilities to work particularly productively and without disruption from home does absolutely bring in the question over the necessity for businesses to have offices, or even offices of such large size. You know, can they get away with sort of smaller offices or more flexible working? So frankly, the outcome of that is unknown. And it's also unknown on the impact that this kind of shift in working behaviours will have on yields and property prices. So over the last month, we've reduced exposure to the property asset class by 50% to try and control this risk. We do still have exposure to a good range of properties in the portfolio, and one that I always like to highlight is kind of our exposure to healthcare properties, so doctors' surgeries, nursing homes. We also have exposure to schools and nurseries where income and yields are very unlikely to be disrupted in the post-COVID world. So again, still have good exposure there, but just trying to control a bit of risk from our property exposure. Secondly, we've looked at adding to our UK equity quality growth stocks. So these are stocks which have been very oversold, in our opinion, given the sort of information we have to date. So what we're trying to do here is try to position the portfolios to benefit from the eventual equity market relief rally when that comes. And that area of the market will likely to be one of the areas that performs particularly well when the sort of sentiment turns. So again, we want to make sure portfolios have got good exposure there. And then thirdly is in fixed income, so bonds. What we've done recently is moved money out of emerging market debt, which you may be aware of, that has recently been downgraded in terms of its credit quality. So what we've done is shifted exposure from emerging market bonds, some of, into more quality bonds with higher ratings. So yes, the returns will be lower there, but again, capital security is higher in the regions that we have moved the money towards. So those are really the three key areas we've been focusing on since the volatility really sort of took hold. And yeah, we're quite comfortable with all the positioning right now.
Okay, so hopefully removing that stance of markets driving value down, or worst case being in the right position to benefit from when the economy is allowed to get back into full swing again and we see those values rise.
Yeah, absolutely right, exactly.
Okay. I suppose one question, and it's how does this fit in with your decision making, is there's no vaccine due apparently for about 12 to 18 months. That will go to health workers, quite rightly, first and foremost, and those key workers on the front line who are keeping the economy moving currently before it gets to the general public. So do we have to build into these decisions and thought process that we're going to repeat this again in another 6 to 12 months, and we're going to see the same kind of epidemic or the same impact on the UK economy?
Yeah, I think the risk of reinfection once social distancing measures and travel bans have been removed is very real. However, from what we're seeing so far, the expectations of the impact of reinfection will be less the next time around than it has been, from the initial spread. So we are absolutely conscious of that, and as will governments be, in terms of how quickly they can allow people back to work and to resume normal life, to try and reduce the impact that reinfection has. It's all about flattening that curve, as you'll have heard many sort of politicians and health experts say. And interestingly, it was Patrick Vallance quite recently said that he is of the opinion that this will reoccur every year, and they'll become more like the sort of common cold or the flu. And actually building up this kind of the horrible phrase, the herd immunity, really in society, will kind of make it have less of an impact than it has the first time around. So yes, very conscious of that, but again, equity markets will price that accordingly, and absolutely it's something that the governments and health experts are trying to control as well. So it is a risk, but we don't expect it to have the same impact as the sort of first initial breakout has had.
Yeah, I suppose there's that element of everything. It's almost a case of, right, here we go again, tick a box, we know what to do, we know what's going to happen. And hopefully businesses, certainly the main businesses on the markets, are actually doing their disaster planning to now include COVID-19 in possible, the like of, in possible future planning.
Yeah, exactly right. Yeah, absolutely.
Okay, so one thing I wanted to ask on top of that, we seem to have hit a point where, I don't know, equity markets, they seem more stable now. We seem to be going through a period where, yes, there's a bit of volatility, but they're holding the value pretty much where they were, other than on Monday, where I presume that was down to the banks deciding that, or under pressure not to pay dividends, Donald Trump talking about oil prices and that pushing oil prices up. That seemed to have an impact, but otherwise we seem to have hit a sort of stable part. Are we actually, in your mind, towards the bottom, or are we just having a pause for breath and we could see things head further lower in terms of the markets?
Yeah, I think it's fair to say that panic selling has certainly eased, and if not, has now sort of ended. So we're kind of in this period at the moment where markets are sort of seeing a reduction in the volatility that they saw late February and earlier on in March. So panic selling is certainly coming, or has come to an end. So we may have reached peak panic, that may have sort of been reached and passed, but peak pessimism is still to come, unfortunately. So a couple of things just to bear in mind. So far, I mean, the response from sort of central banks and governments has been extremely well received by the market, and this we'll do whatever it takes rhetoric that we've seen from governments and banks across the world is exactly what markets have wanted to hear, and I think that has absolutely helped them find a floor for now. We obviously still can't get away from the fact that we have not got any meaningful data to suggest that peak cases have passed. So initial signs in Europe are positive. We are seeing a slowing of infection rates in certain countries across Europe, but the data is not consistent enough to form a sort of more longer term view. So we obviously welcome the early signs, but we're very conscious of the fact that they are just early signs, and it's not enough to form a long term view. On the downside, we do still have problems, obviously, in the US in terms of contagion and how they're looking to contain the spread of the virus. So obviously across the different states, it's going to be different. And the US being the largest economy in the world, obviously the impact it has there will drive equity markets around the world, not just in the US. So word of caution there, we just need to obviously closely monitor what's going on in the US. But yes, early signs from Europe are encouraging. And I think it's fair to say we are past peak panic at the moment.
Okay, so again, the usual thing applying if we're not quite sure where the markets go, but the data coming out, the inference coming out is, yeah, everything is starting to settle. We're pausing, we're breathing, and it's almost becoming like, where do we go from here now?
Yep, that's absolutely right. Exactly. So, I mean, obviously, the sort of next couple of weeks and monitoring that data in Europe will be absolutely vital to the near term and immediate direction of equity markets from this point.